said last time, we started talking about intangible assets, so we covered most of the 6 classes of intangible assets, and including, of course, the goodwill. So we just managed to see how to value this intangible asset. So what will be the cost, of course, to account in our books. And then, of course, we move to talk about if there are intangibles with indefinite useful life or definite useful life, so limited useful life, I mean. We also move to talk about the impairment of intangible assets and so on, okay? So what is left in this chapter is that to see how to present intangible assets in financial statement, and in particular, of course, in the statement of financial position. And then we'll see in the last section, I guess, the issue regarding the research and development costs and how they should be reported in our accounting records, okay? So let's start first by the presentation of intangible assets. So intangible assets, as we said from the beginning, they are what? They are long-term assets, okay? So, and of course, they will be, of course, provided in the statement of financial position within the long-term asset section. But as we learned, intangible assets should be provided in separate items. Okay, so we should, for example, if we have patents, we have copyrights, we have franchise, license, or whatever, we should just report them, of course, in separate way. And in addition, of course, to the goodwill, that should be also reported in separate way. Okay. What is my teams just? So there is no really big difference regarding how to present the intangibles compared, for example, to the reporting of property, plant, and equipment. Remember, for property, plant, and equipment, what we did is that we provide, for example, we have building, we have land, we have equipment, we have machinery. All of these items will be, of course, provided in separate way. So this is how we also proceed with the presence, of course, of intangible assets in the balance sheet. Okay, so we should outline all the intangible in separate manner. Okay, so as I said, if you have copyrights, if I have trademark, for example, if you have franchise license, as I said, patent, goodwill, all of them, of course, will be provided, of course, in separate way. Okay, what is in particular specific to the intangible assets, and remember that when we talked about, of course, those with limited useful life, remember when we record the amortization expense, we don't really use a contra asset account, which is, for example, accumulated amortization, for example, for excuse me, for license or for patent or whatever. We use in particular the account of the asset itself. Okay, so contra accounts are not shown for intangible. Okay, so this is how we are used, and this is how commonly, of course, we provide information regarding intangible assets within our statement of financial position. Okay, so this is unlike, of course, the property, plant, and equipment, when we have, for example, to provide the contra asset, the accumulated, for example, depreciation for building, for equipment, and so on. Okay, so intangible assets will be provided with their net amount, of course, with their book value at the statement of financial position. Okay, so there is no contra account, okay, assets. Okay, this is, of course, about the presentation in the statement of financial position. So now what will be also what kind of information will be reported in the income statement? Remember, so when we have a limited useful life intangible, so we have to record amortization expense. So of course, amortization expense will be part of operating section. Okay, we also have to test for impairment. also for limited or indefinite useful life assets. Okay, so if there is any impairment losses or any reversal, so any recovery for the impairment losses regarding, of course, intangibles, they should be still provided within the operating section in the other income and expense, for example, section for the impairment losses and reversal within the income statements. Okay. So it's also important to note that the amortization expense should be provided for each type of asset. You see what it is meant here? Meaning that we should not, for example, provide a total of amortization expense within the income statement. Okay, no, we should provide it a disaggregated amount, meaning if you have amortization expense for license, if you have amortization expense for franchise, amortization expense for copyrights, for example, etc. Okay, so all of them should be provided in separate way for each type of asset. So we should not accumulate all the amortization expenses and provide only one amount. Okay, so this is, of course, how we should present this kind of information in the balance sheet and in the income statement. Okay, and this is just a snapshot of how some of the intangible assets are reported here for Nestle firm. Okay, so this is on December 31, 2015. You see here we have amortization expense of 370. You may tell me what's about the amortization expense. Well, as I said, it's common that we provide amortization expense for every type of intangible that is, of course, of limited life. Okay, but if we are not providing this kind of information, we should go immediately to the notes disclosure and provide details regarding the amortization expense for every type of limited life useful asset. Okay. Then, of course, we have also impairment of goodwill. Here, this is, of course, the information that should be reported within the operating section of the income statement. The balance sheet here, you are providing the goodwill and, of course, the other intangible assets. Okay, so here just to provide not the entire, of course, detailed here information, but you see that goodwill should be separated from the other intangible assets, where we will also provide details regarding the other types of intangibles. Okay, so again, the common way to provide, of course, the information that we should provide all the details regarding all the intangibles and the balance sheet and also their amortization within the income statement. If we don't do so, we should immediately, of course, report that information in the notes disclosure. Okay, so that's all about the presentation. So it's not really a big issue. It's like we are used to provide this kind of information for property, plant, and equipment, of course, except the minor difference regarding, of course, no contra asset account will be provided, and then, of course, intangibles that are provided with their net book value, not like for property, plant, and equipment when we provide the original cost and also the book value of the asset itself. Okay, last here, learning objective, we'll be talking about the research and development cost. Okay, so remember from the beginning we said that research and development costs, they are here, we have two ways to actually account for research and development costs. Okay, frequently we use it to what? To expense any research and development cost, unless we have some conditions that will be met. Okay, so they should not be, of course, capitalized until the economic viability condition will be proven. Okay, so here it said that, of course, research and development, they are not themselves intangible. I said that's, of course, obvious, because we engage in research and development, so we incur cost, expenditures, etc. with what? With the goal to develop some of the intangible, of course, assets. Okay, so it will yield to the development of patents, copyrights, etc. Okay, for new products, for any processes or ideas. Okay, we can also engage in research and development to provide new formula, new composition, any literary work, etc. So any, let's say, new invention. Okay, but remember, we said that when we have internally generated intangibles, they should not be reported as intangibles. So only, of course, when we have, for example, if you assume that we have what? We internally generated a patent, for example, okay? So we are not, so the cost, of course, that is the cost that we incurred in the process of developing that of course, patent, etc., should be reported, some of it as expenses, and others will be, of course, capitalized. But what will be reported as patents will be maybe the legal fees that we encounter or we incur in what, in defending that patent, etc. Okay, so internally generated intangibles, in most of cases, of course, they are not recognized as intangible assets. Okay, why? As you said, because of this subjectivity in measuring, of course, in evaluating, etc. But of course, we have a way, let's say, to deal with what we incur in the process of developing such intangibles. So for research and development costs, when economic viability is met, of course, here as a condition, then research and development costs will be recorded as part of the asset section. Okay. Here we have example of how important this research and development costs for businesses all over the world. Okay, so we see here, for example, for Volkswagen, it is 5.26% of its entire sales. Okay, for Samsung, it is more than 7%. For Intel Corporation, it is more than 20%. For Microsoft, it is 13%. Google, it is almost 15%. Amazon more than 10%, etc. You see here, this is really to show that research and development costs, that are really important. And imagine you are just using or consuming 10 or 20% of your entire sales in making, of course, this research and development, with, of course, with the objective to develop a new product, make a new invention, of course, yield with the patent, and so on. Okay, so that's why, of course, as accounting, the research and development costs, they really matter. Okay, and how they should be reported in financial statement, that's also a sensitive here question that should be answered, of course, based on some criteria, of course, that the IFRSs are stipulating. Okay. So here, as we said, research costs must be expensed as incurred. So as long as we incur any research costs, that should be expensed in the period in which, of course, we are incurring this research. Okay, so we have to record research expenses, and of course, it should be reported in our income statement. Okay, for development costs, as we said, they can be expensed or not, of course, as incurred. So depending, as we said, on the some criteria that should be met. Okay, so how or when should we, or are we allowed to capitalize the development cost? Only when the project is far enough along in the process, such that the economic benefit of the R&D project will flow to the economy. So here what we're saying is that the project is economically viable. So meaning that we are really, let's say, at the end of the process, so we are making important progress within our project, and that, of course, we are really starting to see that in the near future we'll be able to make benefit from that ARD, of course, project. We will have economic benefit that will flow to the company. And you'll see here we are just following or trying to use the definition of an asset in general to see if we are here allowed to capitalize any expenditures regarding development costs. Okay. So here, as we said, the project should be economically viable. So we start see, as we said, that, for example, we have a product, a prototype of product that is emerging. We start, for example, having, I don't know, customers, purchase orders, etc. That will make, of course, our project economically viable, meaning that I will start generating economic benefit from it. And that's, of course, this is the first time, of course, at this level we are permitted to capitalize, meaning to consider all the expenditures that we are incurring as development costs, of course, in the asset section. Okay. So how, of course, to identify if it is research or development activities. Okay. So here, when we say research activities, they are what? Original and planned investigation. They are undertaken with the prospect of gaining new scientific or technical knowledge and understanding. So here we have example. You can, for example, start initial investigation, start elaborating original plans, you are making prospection, you are just collecting information, all of this, of course, kind of activities that are what? That should be considered as research activities. Like here, laboratory research aimed at discovery of new knowledge, searching for application of new research findings. Okay, so here we are still at the level of research. Still, we are not sure or about, of course, the outcome of this project. We don't really see clear regarding, of course, that project or that activities. Okay. The next here for development activities. Okay, so here we are in another phase. We are in a phase of application of this research finding or other knowledge to plan or design for the production of a new or substantially improved materials, devices, products, processes, systems, or services before the start of commercial production or use. So here in development phase, here we start, let's say, the application, the use of what, let's say, what we theoretically develop it in terms, for example, of I don't know, formula, composition, etc. And we start testing for this. Okay, so when we start testing and we start applying this research funding to a plan or any design of a new product, or to improve any new materials, or let's say to develop a new vaccine, etc. Okay, so this is when, of course, we start talking about development activities. Okay, and as we said, development activities may continue to be recorded as expenses unless what? Unless we have the economic viability criteria that is met. Okay, so here we can see the conceptual formulation and design of possible product or process alternatives, construction of prototypes, operation of pilot plants, and so on. Okay, is that clear, please? Now, that's really important to be able to see the difference between research activities and development activities, because we don't really, there is no problem with research activities. So once you just identify any incurred expenses as research, you should expense them. But of course, the issue is when we have development costs, should we expense or should we capitalize? Okay. Okay. Please, I just need 5 minutes and I will be back, okay? Just give me 5 minutes, please. Okay, sorry for this interruption. So let's see now how to account for research and development, okay, activities, okay? So for the research and development activity, as I said, we can incur expenditures related to the purchase of materials, equipment, and facilities. We have also incurrence of costs regarding the personnel. So here we're talking about, let's say, salaries and wages. we can also purchase intangibles in the process of this research and development activities. We can have any contract services with, of course, the third party. It can be, of course, third-party business or person, etc. We can also incur any other indirect costs, okay? And here we'll see that some of these expenditures, what will be their accounting treatment, okay? So here, when we talk about the construction of long-range research facility for use in current and future projects, okay? So the thing is that when you have to deal with the research and development expenditures, you should, let's say, see if this actually expenditure will be only devoted to this current research and development process, or will be used, for example, in the future in other types of projects, okay? So if it is, or it will be used for other projects, then it should be capitalized, okay? So that's also one of the specific treatment for research and development expenditures. So please keep in mind, when you have any expenditures that are meant to be exclusively used for this research and development project, there is no alternative use, I mean, for these expenditures in other projects, then it should not be, of course, capitalized and until, of course, we have this economic viability proven, okay? But here, if you just consider the examples, like construction of long-range research facility for use in current and future projects. So here we have 400,000 square foot building that is used for current research, but also will be useful for future projects. So we should, of course, capitalize them and also expense them as, depreciate them as research and development expense. So it should be capitalized, and of course it should be depreciated based on the useful life of this, of course, this facility, of course, long-range research facility, etc. Okay, so please, the important here, you should keep in mind that when you have any expenditures that is meant to be used exclusively to one project, in most of cases it should be expensed unless, as we said, we have economic viability proven. But if we have this expenditure, this kind of, I don't know, project, intangibles that we purchase, other assets, etc., we purchase, of course, facilities and so on, and they are meant to be used in future projects, in other, of course, projects, then it should be capitalized, okay? So acquisition of R&D equipment for use on current project only. So see here, that's only current project. So here it should be immediately expensed as R&D, of course, expenses, okay? The acquisition of machinery for use on current and future. So here we're talking about current and future projects. So when we purchase this kind of machine, it should be capitalized and then, of course, depreciated as R&D expense, okay?
Madam?
So that's, yes, please.
In the expenditure.
Yes.
You said we expense immediately as research and development.
Yes.
For example, if we're going to record it as a journal entry,
yes,
we're going to expense the research and development, but what are we going to debit the equipment? Or
no, we said that we should expense it. So please, there is no asset account involved here. So we should write research and development expense. That's an expense account, and we credit account payable or cash or whatever. Okay.
Okay. Okay, clear.
Be careful, please. When we say capitalizing, that's the only situation when we will use an asset account. Okay, so here, for example, when we have a machinery used, so we will debit machinery. Why? Because this machinery will be used for future projects. So this is one of my assets, should be capitalized. So we'll debit machinery. Of course, we credit cash or accounts payable. And then, of course, the use of this machinery now for the current period will be what? Will be depreciated as research and development expense. So we'll be recording research and development expense as what? Of course, this is the amount of depreciation of that machine, of course, in the current period. Okay.
Madam, I have a question.
Yes.
Regarding number 2. So
yes.
First, we have to expense it and everything. But what happens to the equipment if it stays like there but it's not used? So we don't even record anything.
So we purchase an equipment and we don't use it.
Yes. So we only record like accumulated
Please
depreciation.
be careful. So if you are purchasing an equipment or any other type of asset, but you won't use in operation. So this is of course the essence of your question. So this is won't be a property, plant or equipment, of course, item. It will be classified as investment, another class of assets. So for property, plant and equipment that we purchase, but they are not used in operations, okay, they will be reported as investment. Of course, if we are not, of course, in this engaged in purchasing and selling, of course, this asset, so we are not making this activity like the asset will be among our inventories, okay? So in general, please, what is common for businesses if they purchase one of the equipment that is really required to what? To implement their research and development here project. So it's really they are in need of that equipment. So it's, let's say 99%, more than 99% that will be used, okay? If of course it happens that you purchase, which is really strange that you purchase an asset or one of this equipment, I mean, and you will not use them. Of course, if you won't use them for your operation or in this research and development project, then what you'll do, you will record it as investment. Why investment? Because maybe you will keep that equipment purchased for some time and maybe you will dispose of it, of course, when you see it is appropriate. You receive, for example, an appropriate price, selling price or whatever, okay?
Yes, thank you.
You're welcome. The next year expenditure, when you have a purchase of materials for use on current and future R&D projects. So still here, be careful when we have any materials, any equipment, as we said, that will be used for current and also future R&D, it should be capitalized. And when we say capitalized, of course, it will be considered as assets. So here in particular for materials, it will be part of my inventory, okay? So here it should be debiting inventory. And then, of course, the use and consumption of that inventory will be expensed as consumed. So we'll be debiting, of course, inventory expense and or like we did, of course, for supplies expense, etc., or cost of goods sold or whatever. So it should be expensed as consumed. So when we consume it, it should be reported as research and development expenses, okay? So please, you see here the issue is that when you have any expenditure that you purchase and you will be using that expenditure or that material or that equipment, etc., for current and the future, the first step is that you will be capitalizing this, of course, with the amount of the purchase, with the value that you paid for, and then, of course, the consumption, the use up of this material or equipment within the current, of course, R&D project will be depreciated and recorded as R&D expense, okay? Salaries of research staff designing here new laser bone scanner, okay? So here we have salaries and wages for research that is aiming to design here a new laser bone scanner, okay? So we are not really here, we are not told that there will be alternative use, a future use of this, for example, research staff here. And it's nothing about, of course, the economic viability. So here, immediately, we should expense as R&D, okay, expenses. So here, it should be expensive. Next one here, when we have research costs incurred. Yes, just see. Just one moment, please, if you have any. Okay. So when you have research costs incurred under contract with the New Horizon and billable monthly, okay? So again, that's of course will be recorded here as receivable. Why receivable? So here when you just have a contract and you will be receiving this amount, of course, monthly. So meaning that you have this economic benefit that will flow to the business here in every month or every period. That's why, of course, it should be reported as receivable. Okay. When you have material, labor, and overhead costs of prototype laser scanner. So here, the economic viability is still not yet achieved. You see here, we have labor, material, overhead costs, so manufacturing costs in particular for a prototype here of laser scanner. And unfortunately, the economic viability not yet achieved. Okay, so still we should expense them immediately. Okay, so there is no way to record it as an asset. So we only record them as assets only when the economic viability here is proven. Okay. Cost of testing, prototype, and design modification. Still economic viability not achieved, so still should be expensed. Okay, you see here the rule, they are really strict. Okay, they are let's say a clear cut. Okay, so if economic viability is achieved, you can capitalize. If not, it should immediately expense. So here we have really, let's say, for research cost, you have actually two ways to deal with that. First of all, if these research costs, they are meant to just serve the needs for the current project only, they should be expensed. If these research expenditures will be, of course, they are incurred, for example, to purchase equipment, materials, etc., and this, of course, materials and equipment, they will be used in future projects, then you should capitalize. So this is, of course, how to deal with the research costs. If we are talking with development costs here, development costs should only be capitalized when only the economic viability is achieved. Okay, as long as we don't meet the economic viability criteria, it should be expensed again. So we should expense immediately as research and development. Legal fees now to obtain patent on a new laser scanner. What do you think here? When you engage in legal fees to obtain and defend your patent for this new laser scanner that you internally developed after, of course, incurring all these research and development costs. What do you think?
Capitalized.
Yeah, it's good. So here we should capitalize them as patent and, of course, amortize here to overhead as part of the cost of goods manufactured. Okay, so here it should be capitalized as patent. Okay. Executive salaries. Okay, so they are not related to the research and development costs. That should be what? That should be expensed as operating expenses. Cost of marketing, research to promote. Here also there are selling and administrative expenses. So there are operating expenses. They are not part of the R&D cost. Okay. Engineer costs incurred to advance the laser scanner to full production stage. So here we're talking about economic viability that is achieved. So if it is achieved, it should be capitalized as R&D. Okay. So it should be, of course, capitalized as R&D, and then, of course, it should be depreciated and, of course, reported as operating expense. For cost of successfully defending patent, so this is also capitalizing and amortizing, as we said, to the cost of goods manufactured. Commission to sales, staff, marketing, new laser scanner. So this is selling and administrative expenses. It's not an R&D cost. Okay. So that's all for research and development costs. So what is so this question? Why patent? Cyrine, you are asking why patent. So here, as we said, when you internally generate a patent, you are not allowed to record it as a patent. You are not allowed to record or to, let's say, recognize any intangible that you internally generate. But if you engage in, let's say, trial, so you will be paying for legal fees to successfully defend that patent, then all the legal fees that you will incur should be capitalized as patent. Yes, because you let's say engage this amount, you successfully defended that patent, and you already had that patent. Of course, you gained, of course, you succeed to get this, let's say, legal recognition of this intangible as your ownership or your property. Okay, that's why of course it should be reported as patent, as an asset. Okay. So other costs that are similar to R&D, like the startup cost for new operation or initial operating losses or any advertising costs that they are, of course, engaged at the beginning, of course, when we start business. Okay, so here they should be also expensed as incurred, similar to the accounting for R&D cost. Okay, we have another example here of R&D expenses or cost, and just do it quickly, please, to see how much, of course, we should report as research and development expenses. So here we'll see what will be the total amount of research and development expense. So here that's an income statement account. Okay, so we are not talking about capitalizing here. We will be just dealing with which of these items will be considered as expense or as an asset. Okay, so first of all, here we have cost of equipment acquired that will have alternative use in future R&D project over the next 5 years. So here the 330. So we said that it should be capitalized because we have this alternative use in future projects, but at the same time it should be what? Depreciated. Okay, and then of course as R&D expenses will be the depreciation expense that will be measured on a straight line basis here for 5 years. So we should divide the 330 over 5. That's the amount of R&D expense that will be reported. Okay, so this is the $66,000 will be part of our R&D expense to be reported within the current year period. You have material consumed in R&D projects. So here we use up materials in R&D projects. So the entire amount will be here expensed. When you have consulting fees that are paid to outsiders for R&D projects, still should be expensed immediately. For personnel costs involved in R&D projects, still that should be expensed. And direct costs reasonably allocated to R&D projects. So here we're talking maybe about overhead, etc. So it should be also entirely expensed and immediately expensed. When you have material purchase for future R&D projects, so they are what? They are capitalized. And of course, if there is no consumption of these materials, none of these 34,000 was consumed for the current R&D project, then there is no portion need to be included in the current year measurement of R&D expense. Okay, so the total will be, of course, here these $403,000 to be reported as R&D expense within our accounting records. Okay, is that clear, please? Is that okay?
Madam,
Yes.
the first one.
one by one, please. Go ahead, Mariam, and then the others if you have questions.
Miss, the first one. Why are we expensing it? Why did we put the depreciation as an R&D expense and not a depreciation expense?
Because this is an equipment that was purchased for that R&D project. It's not an equipment that we purchased for our operating cycle. Okay, let's say we are a drug firm, pharmaceutical firm, and we have our equipment that we purchased or we use in developing the classic drugs that we are used, for example, to produce, etc. At the same time, we acquired a new equipment, for example, that is needed for developing this vaccine for COVID. Okay, if we assume that this equipment will be also used for future maybe vaccine development, then it should be capitalized, but at the same time, this depreciation expense of that, of course, equipment that is specifically used in the current but also will be used in the future project will be then, of course, depreciation expense will be part of the R&D expenses, because as we said, that equipment is in particular used for that project, for that R&D project. It's not for the, let's say, original or general operating cycle of the business. You see?
Yes, and Miss, when we buy it or acquire the equipment as an investment, as we said earlier.
Yeah.
How do we deal with it?
You won't depreciate it because it is not used. It won't be consuming. You are not, you know what is the depreciation here? Depreciation when you will be allocating the cost of what? Of cost of using this or the cost of this asset over its useful life. And it will what? It will like assimilate the consumption of economic benefits, of course, embedded within that asset. Okay, so if you are in a situation you purchase that equipment, but it appears that you won't need that equipment in the current or in the future project. Okay, so you will record it as investment, and of course it won't be depreciated. There is no depreciation. So when we say investment, it can be, of course, so you will, I don't know, keep it for 1, 2, 3 years, and then you will sell it. You will dispose it when you decide that there is no need to keep that, of course, asset within your asset.
Miss, so when it's for investment, when we use it, we're gonna expense the depreciation in the, like, for example, we bought an equipment for, and it has a useful life of 5 years, but we're going to use it only for 3 years. So we are going to expense the whole like the whole price of the equipment, or are we just going to expense the part that we use, like the depreciation of 3 years?
So you are saying that we have purchased the equipment that will be used in the current and the future R&D projects. Of course,
no, only for one project, but let's say this project has 3 years, like it lasts 3 years, and but the equipment has 5 years.
Please, if it will be used for only one project, okay, so it will be immediately expensed. So there is no depreciation, no recording of assets and then depreciation. See?
So the whole, for example,
the whole amount won't be considered as an asset. It will be considered as R&D expense.
Okay, I get it.
You're welcome. Thank you. Other questions, please? All good?
Yeah.
Hope so. Okay. What we have here, we have just the snapshot of this R&D cost within the GlaxoSmithKline. This is also a pharmaceutical firm. So this is how they report research and development expenses. You see here you have the turnover. So these are sales revenues. You have the cost of sales, and then you have the gross profit. You have the selling with general and administrative expenses, and you have also research and development expenses. You have also royalty income, so the other income, other expenses, etc., other operating income, and then the operating here income is of 10 million pounds, 322 pounds. Okay. So of course you see here that this is a research and development expense. This is what snapshot of the income statement of that firm. Okay. So that's all for this chapter 12. Do you have any question, please, before we move on to chapter 13? Well, it's really heavy in details and the information that we should cover. So in chapter 13, please, we will try to make a quick progress regarding the first year section, because what is important for us, just try to share chapter 13. So as I said, chapter 13 will be about current liabilities, provisions, and contingencies. Okay, so we'll go through quickly the first section when we're talking about the different types of current liabilities, how to value them, how to report them. In particular, when we are dealing, let's say, with the current maturities of long-term liabilities, that's the new maybe for you regarding the current liabilities. And then we'll be talking about other types of liability, which are provisions with our contingencies, etc., which are most important, of course, and really new for you as a junior student. Okay. So in the first year, which is really long, very long, the first section will be talking about the different types of current liabilities, and of course, how to account for them. So I will do it really quickly. So if you have any problem, you can just raise it. We can discuss it. But as I said, we'll move on quickly to the other sections. Okay. So first of all, to know, of course, if any item should be classified as current liability or not, or any, of course, maybe class within the financial statement, you should see if this item will obey, of course, to the general definition of a liability. Okay, so remember when we're talking about here current liability or liabilities in general, we said what is a liability according to the conceptual framework? It is a present obligation that is arising from past events, and the settlement, of course, of this obligation will result in outflow of resources, embedding, of course, cash, like, of course, cash, goods, and services. So when we talk about outflow of resources embedding economic benefits, that will be, of course, in the form, for example, of decrease of cash, or, of course, decrease of any type of assets. Okay. So again, this is a general definition, of course, of a liability. Okay, so it is a present obligation. That's important. You have a present obligation, and this obligation arises because of past events, you made a transaction in the past, etc. And of course, when you will settle that present obligation, you will incur this outflow of resources in the form of cash, of course, decrease, or any type of other asset, of course, decrease. Okay. So this is what I'm saying. So you will always use the conceptual framework definitions as a basis for resolving any controversial classification issues. Okay, so you will have these definitions of assets, liabilities, and equities within the conceptual framework. So if you are not really sure if this item will be considered as asset or liability, or if here we're talking about specific financial instrument, if it is an asset, if it is receivable, or if it is a liability, you should just go back to the definition of one asset or definition of one liability, and then it will be helpful for you to say in which class, of course, the item will be included. Okay, so that's, of course, the general definition of a liability. What is a current liability now? So here we have two conditions that should be met if one item will be reported as a current liability. So here we are in a situation that this liability is expected to be settled within its normal operating cycle. So as a business, within my operating cycle, this liability is expected to be settled, or this, of course, liability will be settled within 12 months after the reporting date. Okay, so here we can have the situation that I have a liability, I'm expecting to settle, to honor that liability within my normal operating cycle, or also it will be settled within 12 months after the reporting date. Okay, so when we say operating cycle, how we define it, this operating cycle? So simply, that's the time elapsing between what? The acquisition of goods and services and the final cash realization resulting from the sales and subsequent collections. So operating of cycle of the business, meaning that you have goods and services that you acquire it. You may, if you are, for example, a merchandising firm, you acquire them, these goods and services, then of course you sell them, then you have receivables, then you collect that money. All this is what you call operating cycle. If you are manufacturing, you have, for example, materials, you purchase that materials, then you manufacture, then of course you sell, then you have a receivable, then you collect that receivable. So this is the operating cycle, how it should be defined. And that's important because we always consider either 1 year or operating cycle, whichever is longer here. Okay, so if the operating cycle is more than 1 year, then we should consider the operating cycle as a basis for deciding if it is a current or long-term liability. So please keep in mind, a current liability can be what? A current liability that will be settled within the operating cycle or within 12 months after the reporting date. So meaning what? We are in December 31 and we assume that amount of liability will be settled within the 12 months after that reporting date. So that's how we should classify it as a current liability. So in particular, the second item here, you see it's about the classification from long-term liabilities to the current liabilities. Okay, so we'll see an example about that. So the typical here types of current liabilities, you know, the account payable, notes payable, and this is what I said, the current maturities of long-term debts. So this is the example of what? Of a long-term liability that will be settled. Portion of it, of course, will be settled within 12 months after the reporting date. So this portion, this proportion from this long-term debt will be reported as current liabilities. علاش على خاطر it will mature within the 12 months after the reporting date. That's why it should be this portion, of course, only will be reclassified as current liabilities. Okay. We have also short-term obligations that should are expected to be refinanced. So here it's about obligations that you are expecting to be refinanced. Of course, we'll see the example. If you have any dividends payable, of course, they are current liabilities. If you make any customer advances and deposits, that's also liability. If you have unearned revenues, remember that it's current liabilities. If you have any sales or value added taxes payable to, you know, for taxes and dividends, they are always current liabilities. As I said, for income taxes, it's also a current liabilities, and any other employee related liabilities. Okay. So accounts payable, they are also called trade accounts payable. Okay. So what do you mean by accounts payable? They are balances that are owed to others. So I owe money to other, of course, suppliers and other businesses for goods, supplies, or services that I purchased on an account. Okay. So I purchase supplies, goods, or services on account. So that's, of course, when I should record it as accounts payable. Okay. So the time lag between the receipt of services or acquisition of title to asset and the payment for it. Okay, so I'll keep it, of course, I will record it as account payable when, of course, when I receive the service or acquire the title, until, of course, I will dispose of it, or I will settle that, so I will pay for that amount. Okay, so remember, when you have, for example, this inventory, for example, purchases, we use these terms like 210, 30, or 110 at the end of the month, etc. Okay. So these terms of sales will state what? The period of extended credit commonly 30 to 60 days. So of course, when we purchase on account, we purchase on credit, we have the credit terms that we should, of course, keep in mind. So we may have, for example, offered a discount, or we are, for example, required to pay the full amount after 30 days or at the end of the month, etc. Okay, so these are, of course, the credit terms that should be agreed upon, of course, between both parties. Okay, so this is about accounts payable. What for notes payable? So here, what is different from accounts payable regarding notes is that here we talk about written promises. Okay, so we have really an official document to prove this, of course, liability or this money owed to that person or to that entity. Okay, so there are written promises to pay a certain sum of money on a specified future date. Okay. In particular, so these written promises will show what is the amount of liability, what will be the maturity date, what are the term of the credit, and so on. Okay, so in our here في تونس نحكيو على lettre de change, يعني على الكمبيالة. So notes payable, these are this example of lettre de change. Okay. So it can, of course, we can issue notes payable when we purchase, or when we have, for example, require financing from banks or other institutions, or any other transactions. Okay, so it can be, of course, classified as short-term or long-term, depending on what? Depending on the maturity date of that notes. Okay. Notes, they can also be interest-bearing or zero interest-bearing. So meaning we can explicitly show how much, of course, amount of interest, or if it is zero interest-bearing, but it is implicitly, of course, bearing interest. Okay, so one of the also major differences between accounts payable and notes payable, that notes you will have to pay interest over that money owed. Okay, and we have here example with this interest-bearing note. Okay, so Castle Bank agrees to lend 100,000 on March 1st to Landscape. So if Landscape signs this 100,000, 6% for month note, what will be how to record the cash received on March 1st? So of course we will debit the cash with the face value of 100, and we credit what? Notes payable for the same amount. So that's on March 1st. Okay. If here we are assuming that the Landscape is preparing financial statements semi-annually, so at June 30. Okay. So if we call or we close or we prepare financial statement at June 30, here we have what? We have to accrue for interest expense, okay? Because you know, for notes, the principal, the face value, and the total amount of interest will be paid, of course, at maturity date. But it doesn't exclude the fact that as accounting, accrual accounting, I should what? I should accrue for this interest expense that I incurred from March until June. So here we have actually 3 or 4 months here of accrued interest. So how to measure that? Of course, the face value times the annual interest rate times this time per rata. So we have 4 months of accrued interest over 12 months. So we have 2,000 of euro to be recorded as interest expense and interest payable. Okay, so I will debit interest expense and credit interest payable for that amount. Okay. Then at maturity date here, July 1st, I will pay what? I will pay the notes plus all the interest, okay, expenses accrued, and also what is, so here we have the 4 months already, all the interest was recorded as interest expense and interest payable. So we will debit if we are paying this note. So we'll debit notes payable and we'll credit also, we'll debit also interest payable, and we'll credit, of course, cash for this 102,000 euro amount. Okay, so this is the situation when you have explicitly, of course, here mention of the interest rate here over the note. Imagine now if we have this zero interest bearing note. Okay, so here we have issuance of 102,000 4-month zero interest bearing note to Castle Bank. Okay, so here the face value, of course, of the note, it's 100, or the present value, it is 100. So as if I will be issue notes, this is zero bearing, of course, I will be receiving what? The 100,000, and I will be paying the 102. Okay, so I will debit cash for only the present value, and I will credit notes payable for the same 100. And then, of course, I should what? I should increase the notes payable here account with the amount of 2,000 here of the interest, to be able, of course, to meet this face value of 102 at maturity date. Okay, so here when we talk about recognizing interest expense, so it should be what? We debit interest expense and we credit notes payable. So see the difference when it is a zero interest bearing note, meaning that this amount of interest won't be reported as interest expense, but instead it will be reported at notes payable, because at maturity date I should pay the 102 and it was issued at 102, so my notes payable should be increased by 2,000, and then of course at maturity date I will debit notes payable for the entire amount, and I will credit, of course, cash for that amount. Okay, so that's the 2 examples of zero interest bearing notes and also interest bearing notes. Okay, let's see now exercise here when we have just some selected transactions, when you have to deal with some accounts and notes payable. Okay, so September 1st, we have a purchase of inventory from Orient Company on account for 50,000. Derby record purchases gross and use a periodic inventory system. Okay, so it said that you should report it at gross, and there is a periodic inventory system, so you won't use the inventory account here. Okay, issued 50,000 12-month 8% note to earn in payment of account. Borrowed 75 from the Shore Bank by signing 12-month zero interest bearing 81,000 notes. And then you have to prepare the journal entries for the selected transaction. So let's do it quickly. When you purchase here inventory for 50,000 on account, so we said you'll be using here the periodic inventory system. So we'll debit purchases for 50,000 and credit accounts payable for the same amount. Okay, so that's September 1st. Then we have issued of 50,000 12-month 8% note to earn in payment of that account. So here we will what? We will switch, or we will change the accounts payable, or convert, the appropriate term, convert accounts payable to notes payable. Okay, so we will debit that accounts payable and we credit notes payable for $50,000. So here, as it said here, why this conversion? Remember, if you report, remember the accounts receivable chapter in the freshman. So sometimes you fail to pay within, of course, the agreed here credit terms, etc. And of course, you will have a new, let's say, agreement with the seller, with the supplier. I agree, for example, to extend this credit term, but at the same time, I will require that you will sign a note where, of course, there will be, as a supplier, of course, I will be receiving interest over that money. Why? Because of this extended credit term. Okay. So this is October 1st. How much? Of course, I will have interest from October to December here. So we have 3 months of accrued interest. So $50,000 times the 8% times 3/12, that's 1,000. So at the end, of course, December 31, I should what? I should accrue the interest expense. So a debit interest expense and the credit interest payable for 1,000. Okay. Next, on October 1st, we have borrowed 75 from the Shore Bank by signing 12-month zero interest bearing 81 notes. So here we borrowed money, so we debited cash for 75 and we credit interest, notes payable for 75. Okay. And then, of course, on December, we should what? We should accrue for interest expense and, of course, increase the notes payable amount by this amount of interest. So here we have 75. Or the difference, of course, 75, 65, 75, the difference between 81 and 75, that's the total, let's say, the annual interest amount to be paid. So we have $6,000 for 12 months. So if you want to accrue interest for only 3 months, of course, we should multiply by this time per rate of 3/12. So we have what? From October to December, we have to accrue 1,500 as interest expense. So we will debit interest expense and we credit notes payable. Why? Because this is a zero interest bearing note. Okay. So this is how to account for this any type of zero interest bearing notes. Okay. The second example here, when you have a current maturities of current maturities of long-term debts. Okay, so what do you mean by current maturities? So they are what? Portion of bonds or mortgage notes or other long-term indebtedness that mature within the next fiscal year. So meaning what? Within the 12 months after the reporting date. Okay. So of course we should exclude that portion from long-term debt if they are to be what? Retired by assets accumulated for this purpose that properly have not been shown as current assets. So exclude long-term debts maturing currently if they are to be so please excuse me. So again, we should consider as current maturities of long-term debt any portion of our debts, of course, of our long-term debt that will be what? Maturing within the next fiscal year. But we should exclude from this current maturity issue what? Any portion of this, of course, long-term debt that will be what? Retired by assets accumulated for this purpose that probably have not been shown as current assets. So simply put here, we should exclude it from these current maturities of long-term debt any portion that will be what? That will be, let's say, settled using long-term assets. Okay. Or refinanced or retired from the proceeds of a new long-term debt issue. So that's also the same situation. You will be maybe retiring or settling this portion with what? With this process of refinancement using a new long-term debt issue. So of course, if you will be having a new long-term debt to finance, of course, these current maturities, then of course you should not consider as current maturities. Okay. And also, you should not consider this portion as current maturities if they are converted into ordinary shares. Okay, so these are the situations when you have to exclude actually these current maturities of long-term debt from this reclassification from long-term liabilities to the current liabilities. Okay, so let's see here in details when you have these short-term obligations that are expected to be refinanced. Okay. So here, as we said, if you have short-term obligations, so meaning what? If you have current liabilities, but you are expecting to refinance, meaning to settle that short-term obligation, but of course, it will be refinanced using maybe long-term liabilities. We'll see, of course, the conditions. Okay. So we should exclude from the current liabilities if both of the following conditions are met. So must intend to refinance the obligation on a long-term basis, or must have an unconditional right to defer settlement of the liability for at least 12 months after the reporting date. Okay, so here what is said: you can have short-term obligations that initially they are considered to be current liabilities, but if you are expecting to refinance this short-term liability using an obligation on a long-term basis, then you should no longer consider them as current liabilities. Okay, if you have also this unconditional right to be able to defer the settlement, to adjourn the settlement of that liability for at least 12 months after the reporting period, then you should also exclude this from the short-term obligation. Okay, we'll take a break, please, for 10 minutes and we'll go back. Okay, just 10 minutes. I will be back. Okay.
يا رامي مادام خرجت قص الريكوردينج بالله وهاو تحل. رامي
وي
قص